Investors play an increasingly influential role in shaping corporate sustainability strategies. Through capital allocation decisions, shareholder engagement, proxy voting, and stewardship activities, investors encourage companies to improve environmental, social, and governance (ESG) performance. Institutional investors, asset managers, pension funds, and sovereign wealth funds often evaluate sustainability risks and opportunities alongside traditional financial metrics. Companies seeking access to capital are therefore incentivized to strengthen sustainability governance, improve disclosures, establish emissions reduction targets, and integrate climate considerations into business strategy. Investor expectations have become a significant driver of corporate sustainability initiatives, particularly as evidence grows that ESG factors can materially affect long-term financial performance and resilience. Sustainable and green finance continue to evolve as markets, regulators, and stakeholders develop more sophisticated definitions and frameworks. Traditionally, sustainable finance referred broadly to the integration of environmental, social, and governance considerations into financial decision-making. Green finance focused more specifically on activities generating environmental benefits, particularly climate mitigation and adaptation projects. Emerging approaches increasingly emphasize measurable outcomes, transition finance, natural capital considerations, biodiversity protection, and alignment with international sustainability objectives. There's also growing recognition that sustainability encompasses both risk management and opportunity identification. As sustainable finance matures, definitions continue to evolve toward greater specificity, transparency, and consistency across markets and jurisdictions. The financial industry has increasingly adopted frameworks that distinguish between different sustainability objectives and investment approaches. These approaches include ESG integration, sustainable investing, responsible investing, impact investing, thematic investing, green finance, climate finance, and transition finance. While each approach differs in objectives and methodologies, they share a common focus on incorporating sustainability considerations into financial activities. Emerging frameworks increasingly emphasize outcomes-based assessments, alignment with net zero objectives, and contributions to sustainable development goals. This evolution reflects growing demand from investors, regulators, and society for financial products that support environmental and social objectives, while maintaining robust financial performance and risk management standards. Corporate ESG disclosure requirements have expanded rapidly in response to investor demand, regulatory initiatives, and growing awareness of sustainability-related financial risks. Historically, sustainability reporting was largely voluntary and varied significantly across organizations. However, companies are increasingly expected to disclose information regarding governance, strategy, risk management, emissions, climate-related risks, sustainability targets, and ESG performance metrics. Frameworks, such as climate-related disclosure standards, have contributed to greater consistency and comparability. Investors use these disclosures to evaluate risk exposure, assess management quality, compare companies, and make informed capital allocation decisions. Consequently, ESG reporting has become a critical component of corporate transparency and accountability. Several notable trends characterize the evolution of ESG disclosure requirements. Regulators increasingly seek standardized, decision-useful, and comparable sustainability information that can be integrated into financial analysis. Climate-related disclosures have become a particular area of focus due to the materiality of physical and transition risks. Companies are facing growing expectations to disclose emissions data, climate strategies, scenario analyses, governance structures, and progress towards sustainability commitments. In addition, disclosure requirements are expanding beyond climate to include biodiversity, human capital, supply chain impacts, and broader sustainability considerations. These developments reflect efforts to improve transparency, reduce information asymmetry, and support more effective risk management. Regulatory trends in sustainable and green finance continue to accelerate globally. Governments, financial regulators, and supervisory authorities increasingly promote sustainable finance through disclosure requirements, green taxonomies, climate risk management guidance, sustainable investment standards, and green bond frameworks. Policymakers seek to direct capital towards sustainable economic activities while reducing greenwashing and enhancing market integrity. Regulatory initiatives also encourage financial institutions to incorporate ESG and climate considerations into governance, lending, investment, and risk management practices. As climate change, biodiversity loss, and other sustainability challenges become increasingly important economic issues, regulatory frameworks are expected to continue evolving to support transparency, accountability, and sustainable capital allocation.